In a recent speech, William Dudley, President of the Federal Reserve Bank of New York and Vice Chair of the Federal Open Market Committee, summarized the job of the Federal Reserve in this way. Congress has set an explicit objective for monetary policy: to pursue the highest level of employment consistent with price stability. This elegant formulation tells us that Congress wants the Federal Reserve to make choices that will keep unemployment low insofar as those choices generate inflation that is neither too high nor too low. But implementing this formulation of the Federal Reserve's job immediately confronts us with some practical difficulties. I think about Congress's mandate of price stability as requiring the Federal Reserve to follow policies that will give rise to an average annual inflation rate of 2% over the next 3 to 4 years. What exactly is the highest level of employment consistent with that definition of price stability? The answer to that question would be easy to estimate if that maximum employment level remained constant over time. But the high inflation, high unemployment period of the 1970s taught us that it does not. In this year's annual report essay, I discuss how policymakers can use real-time data to make monetary policy choices that allow them to achieve the highest level of employment consistent with price stability. My main conclusion is that data on aggregate labor market quantities like unemployment and job openings are highly imperfect guides to the making of monetary policy in the context of an ever-changing macroeconomy. Fortunately, I do find that data on the rate of change of inflation can be a useful supplementary source of information. I argue that this information about 2010 inflation and its rate of change signals that the Federal Reserve's highly accommodative policy of low interest rates and large-scale asset purchases was indeed appropriate at the end of 2010. Of course, conditions change, and I will be watching the evolution of inflation in 2011 carefully as I assess the appropriateness of monetary policy.